Good afternoon. This is September 28th, 2024 on a Saturday. I'm just going to quickly go through the RPD strategy, the rolling put diagonal, just for myself to practice and get better at trading. Uh, First of all, I'm going to try to follow Bill Belt's trades that he started on September 23rd. So let's go into Option Explorer and put in his trade he did on September 23rd, which was here. So he sold the 572 put at 188 and bought for protection the 567 put for 457. So we'll do that. So we'll go to September 23rd, which was a Monday. And let's see, he posted that around 8:44. So let's just say it was about 7:30, a little after 7:30 market open. Um, 8:44. Let's go here. That was 571.59. Okay, must be mountain time. Okay, so he went the next day. Well, first I want to go to October 10th, 14th, and buy the fifth 567 put. Buy that one. He bought that for 457. Wrong one. 457. Let's see, is that it? 567 at 457. Okay. And then went to day after. And I think 572 at the money. He sold the put for income. And he got, what did he get for that? 188. It's close enough. I don't think our times are all different. I'm not sure if he's in Eastern time or if it's Mountain time. I don't think it's Eastern. Don't commit that. Back test. RPD, we'll put 092324 for a debit of 271. Let's see. What did he get? He doesn't say, but it would have been it would have been 457 minus 188. He would have got 269. All right, so let's go to 269 just to stay consistent. And then let's go to the next day. Oh, before we do that, I do want to enter that into the spreadsheet. And these are the rules on the right side I'll talk about a little later. On 9/23/24, 10/14/24 expiration, and 9/24/24 expiration for the short. The strikes for the long was for 567. For the short was 572. The deltas, let's see the deltas. Let's go back. Previous adjustment. Oops. Previous adjustment. Why is that not in there? This one. Okay, the delta for the short was 51. 51 here. The delta for the long was 30, this is K 36. I don't know what happened there. Anyways. Mm, okay. So the one of the rules or criteria for the delta percent difference is the delta of the long leg will have a 20% to 40% difference from the short leg delta. So we're at 42%. Ideally, we want to be between 20 and 40%, but this should be okay. And then what do we pay for these? Let's check real quick. Oh, um, for the long, we paid 457. For the short, we got $8.88. And income ratio is another criteria. Income from the short leg should pay roughly half of the cost of the long leg. So 41%, pretty close. Another criteria for the strike width is maximum width between the short and the long strikes is 10 points for XSP and SPY, 100 points on SPX. Hopefully someday I can trade the SPX on this. This was our net debit. And then another criteria, net debit of strike width. Net debit should be less than 75% of strike width. And it is at 54%. So basically, we don't want to pay too much for this trade structure relative to the strike width. And we don't want the strike width to be too much either. All right, so before I continue on, just wanted to bring up um, the chart that he likes to look at, not this one. Let's go to trading view chart. It's here. Okay. So he likes to use the 9 EMA on the daily chart, make sure like on the 23rd it was above the 9 EMA, and then he also likes to look at the 98-minute chart on the 23rd, then on a Monday here. So it was above. So that's bullish. And he also likes to look at a reversal and support lines. We're above, but I think this was good enough. Also like to look at the 130-minute chart. That's all good, bullish. So everything's bullish for all-time highs. Go back to the daily real quick. Yeah, I can see we're at, like on this day even, we're at all-time highs at the top of the Keltner channels, which is not ideal, but good for RPD. So let's continue on and we'll go to the next day, September 24th. At 12:09. Let's go to 12:09. Basically during lunchtime. Well, lunchtime Mountain Time. Okay. He decided to roll. for a net credit of $1.04. Okay, so this is expiration day anyway, so you have to roll it. So he takes this and rolls it to the same strike at the money. No, he went 573. And what did he get for that? He said he got net credit of $1.04. So I would just at the wrong time difference. Yeah. Okay, that's close enough. And using buying power of 843 per contract. So he gets that from the brokerage when he does his transaction, which we're not doing real trade here, so it doesn't matter. Okay, let's go to the next day. Right, $84 profit, 10.9%. Okay, looks like it's a down day, $1.62. So at 11, let's go to 11. Roughly 11. He said 11:12, so we'll go to 11:10. XSP was 573. So um, I want to say it's probably Central Time. Or was it Eastern Time? I think he's Eastern Time. So we'll go to 9:10. Um, XSP was 573. I rolled today's put to tomorrow's put for a credit of 70 cents. It seems that the market makers are holding on to the extrinsic value, uh, holding on to the extrinsic time value longer right now. Might be they're on to 1DT traders rolling early. I'm going to start looking to roll around lunchtime and see what that does. So he takes this. Oops, wrong one. Sorry. Go back to the correct one. Okay, takes this one, which expires today, closes that, and rolls it to 573 at the money. Okay, and you got 70-cent credit for it. So we'll do 70 cents credit, save. All right, $120 profit, 17%. That's pretty good. Okay, let's go to the next day, which is Thursday, the 26th at 1:22 Eastern. So let's go to 11:20. Okay, what does he do? He rolls it again for net credit of 75 cents. Buying power used is 822 per contract. Um, let's roll this, close that. Um, 573 to 573. Commit that. He got 75 cents. We'll save that. And we're at $176 profit, 28%. Let's go to the next day, which is Friday the 27th at 11. So we'll go to 9. Let's see here, 9 a.m. Looks like he went back to rolling in the morning. He rolled, let's see, 573 to 575 because the market is up $1.25. So let's close this. We're going to go up to 575 for Monday. We committed that for $12. That's what he got. Okay. So up to 22. That's pretty good in like 5 days. That's 30%. So I'll continue to follow his trades that he posts and see what his final results are. And then I think he's going to have his September results in a spreadsheet that he'll post that I'll put in another video. And right now, though, I want to go through his criteria and his entry and his management of the trade, his rules. Um, so I'll just talk through it so I have it on video. Make sure the delta on the short is higher than the delta on the long, which is the case here. The delta of the long is further out of the money, so it should be lower. And then the delta of the short is at the money, so it should be around 50, which will be higher than out of the money. You want to roll when the data on the current short is lower than the target short strike. So you will continue to have maximum time decay. Yeah, so you want a higher theta when to the strike you roll to, which I think we saw, your theta is going to go up here when you do a model trade to um, a different expiration day, right? So you have to look at that, which we didn't, but I need to make sure I do in the future. Draw support lines where it could pull back to and bounce off of. Use SMA 9, SMA 15 on daily chart. He's updated this to a more simpler charting that I showed earlier. So we'll go with that charting. And then consider exiting on 195. Okay, we'll skip that. Okay, entry rules. Wait for a reversal in at least 2 days going in the direction of the trade. Price has pulled back and found support, and for 2 days there has been green candles, and the SMA 5 should be above the SMA 9. Open short leg on the next expiration at the money at 50 delta or slightly in the money. Open long leg at least 14 to 45 DTE, delta 30 to 40. And our delta for the long was 36. So that's between 30 and 40. And our DTE was 21, which is between 14 and 45. Income from the short leg should pay for roughly half of the cost of the long leg. So income ratio here, we only paid about 41% of the long leg debit, but this was close enough. Ideally, the delta of the long leg will have a 20 to 40% difference from the short leg delta. So the delta difference for us was 42%. Oh, sorry, the income ratio was okay, 42%. So that's good. Well, it's close enough. We want to be between 20 and 40% delta of the long leg to short leg. Not a good time to open a trade if the pricing is getting extended or it is hitting new highs, which right now we're at new highs, but we entered one anyway. Maximum width between the short and long strikes is 100 points on SPX, 10 points on XSP and SPY. So our strike width was 5, so that's good. Long put end of month expiration at 30 to 40 delta, which we did. The net debit is less than 75% of strike width. The net debit in our case was less than 75%. It was at 54%, which is good. So we don't want to pay too much relative to width of our strikes. All right, rolling. You want the long delta to be at least 20% less than the short, but not more than 50% less. So we want to be between 20% and 50% for the delta of the long. So the delta we're at 42%. So the delta of the long was 36 and the delta of the short was 51, which is basically 42% difference. So we're good there. Basically, we don't want the long delta to be lower, too much lower. So we don't want this to go, you know, too far out of the money. The lower the delta, the further out of the money you are, because that wouldn't protect you enough when the market decides to pull back. So you want to be somewhat close to at the money. All right. Where were we? Can roll early if the extrinsic value is less than 10 cents. So we can look at that in one. I added this column extrinsic value. If it reaches, 10 cents or lower, then we can close it. We can roll early. Adjust long put if delta spread is less than 50% or greater than 40%. That's what I just talked about before. We don't want the long leg to go further out of the money because it wouldn't protect us. Um, and the delta spread, long put if delta spread. We want the delta spread to be between 15, 40% also, which is here between the long and the short. And exit entire position if SPX breaks below 15-day moving average. That's probably a good rule to follow. If you don't want to be in it when the market starts crashing or having a major pullback, roll both legs down in pullbacks. Okay. And these were his rules that he had on his spreadsheet that I'll just talk about real quick. So I have it on video. Okay, this trade works best in slightly bullish overall trends. Do not use it on highly volatile positions. This is not a poor man's covered call. It requires much less capital and data decay is much more favorable with the rolling put diagonal. The structure of the trade closely emulates the income from a naked put. However, it's leveraged and protected by a long put further out in time and at a lower strike price. Many traders consider this a hybrid between a calendar spread and a put credit spread, gaining income from a short-term position and protecting it by buying a longer term further out of the money strike. It is your choice to manage the long protective put or not. There are two advantages to managing the delta difference between the long and the short position. Number one, longer term put dictates the amount of capital required or buying power used. Keeping the spread tight, strike price above about 20% to 30% different, increases the return on buying power. The protective long put needs to be at a delta that if there is a pullback, the value will begin to increase. Too far out of the money, you will have an adverse effect in a pullback, and too close to at the money, beta decay will also have an adverse effect. The longer term charts to decide the overall trend, you're buying a protective put that will cover a longer term. Do not use a chart by minutes. It has too many fake outs based on longer term momentum. Opening the trade. Number one, simultaneously sell the next expiration at the money strike and buy a protective put further out in time and further out of the money. Number two, the expiration of the long protective put should be 14 to 30 DTE for an index, and for a stock, we don't care. Number three, if it is a stock, well, we don't care. On expiration of the short, number one, roll short to the next expiration. Number two, if the underlying has gone up, roll to the at the money strike. Number three, if the underlying has stayed the same, roll to the same strike next expiration. In a downturn, potential adjustments are number one, decide to either buy to close the short leg and let the long leg run, or number two, if it seems to have found support, either roll to the same strike next expiration for a credit and wait, or number three, adjust down the spread, or number four, go to cash and wait. Remember, rolling is an art, not a science, and that you want to roll in your favor, not the market maker. You are best to manage both delta and theta to your benefit. If our position is not a cash settled underlying, you may need to tell your broker that you are monitoring the position so the risk department does not prematurely close the short position. close a diagonal before the expiration of the long and decide to start a new diagonal or wait for the next bullish cycle. Okay, and that is it. And I'll make a video to finish this trade out, and we'll see you in the next one. Bye.